All right. What is up, traders? What is up, tycoons? Super excited for today's video. Lots to talk about. We're going to go over crude oil breaking out. All right. We see the long-term trend here as well, breaking out from a very, very long-term trend from the great financial crisis. Right, we're going to go over, some ratios and relationships between energy and the S&P 500. We're also going to show how, closely energy correlates with treasury yields, and we'll basically break that down why. And then we're also going to go into some more ratio charts here. We have the XLE SPY ratio chart. We have the XLE XLK ratio chart. Now, I've showed these before in the past, and it's been a little while since I've, done an update on these. So we're going to go ahead and show some of the progress that they have made. Now, those charts are some of the charts that I've included in my free newsletter, right? I started a completely free newsletter for you guys, that gives out free trade ideas as well as just free valuable content. So if you guys are fans of that, I'm sure you'll enjoy it. This was the Tesla trade setup that we had when everyone was bearish on Tesla. We went long on Tesla, right? And this was the trade idea. And you can see, since Tesla has broken that trend line, it's gone up very significantly. Call options went up a very significant amount. If you're not familiar with options, call is basically a bet that the stock is going to go up. All right. I also started a Ko-Fi page. Now, this is a really good way for you guys to reach out to me. You can now book your coaching sessions through Ko-Fi. There's a link in the description for Ko-Fi as well as for the newsletter. You can sign up for those, through here. So yeah, book your coaching sessions. You can also do viewer request if you guys ever want to request a specific YouTube video, tailored to exactly what you're looking for. You can request a YouTube video on there. And if you ever just want to, buy me a coffee and do a tip, all right, you can also tip on the Ko-Fi platform. So really nice way to engage with me, reach out to me, and also help support the channel if you guys enjoy it. Now, as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the full disclaimer. And before we get into our charts, there's a bunch of really good data that I want to show you guys. Now, we've talked about this before, but we have our September seasonality. Okay, and look at where we are right now, right? We're basically right around this area here, and we've seen that the market's been rallying right now, okay, and the market could have a little bit more legs up, but from a seasonality standpoint, and this is pre-election year seasonality specifically, we can see that the later half of September, typically you start to see a pullback, right? And that's something that, is not guaranteed to happen, but it's something that we want to be prepared for the possibility of, this happening to us in September. Right. This is just another chart right here showing that basically around the 19th, to the end of the month is usually, when you get those bad returns. It's usually when trouble occurs in the S&P 500 index, right? Is going to be that last half of September. So this is something that you want to think about, and, keep in mind. Now, what we're seeing here is basically cumulative short flow across U.S. equities is at a new year-to-date high. So, basically what we're seeing is massive short positions, and we're seeing, hedge funds and institutions shorting the market now, ahead of this bad September seasonality. So the big question you have to ask yourself, right? The question, okay, is if we're rallying right now, are we rallying into liquidity for all of these massive short positions that are looking to catch the move down towards the end of the month and then possibly, get out of the position there. So, it's just really interesting when you look at the seasonality and then you take a look at the, cumulative short flow, reaching new highs right there. Now, this is global sector fund flows. And so basically the big takeaway from this chart is technology, right? We're really seeing basically no fund flows into anything besides technology, right? Technology is the yellow line here. This is over the last 12 months. What's really interesting though is that energy, look at energy in green here. Energy and financials been lagging, right? So, energy and financials were things that were leading the market last year. Okay. And that's where a lot of the money was going into. And we're seeing basically the exact opposite of that right now. But what's really interesting is, seeing where energy is at and then, looking at the actual charts of energy and where energy is going. So, if we do actually start to get a lot of inflows into energy, that could boost the energy prices in the stock market even more. Now, oil price is at a 10-month high, and U.S. crude inventories are at a 40-year low. So, again, this is just more of the narrative surrounding energy right now, surrounding oil prices. And, this is some good data that I think you guys need to be aware of. Now, the adoption speed of technologies has tended to accelerate over time. Why am I showing you guys this, right? I mean, you can see the cell phone, you can see color TVs, the vacuum, automobile, electric power, radio. What's not on this chart yet is AI, okay? And AI, as this chart suggests, the adoption speed of technologies has tended to accelerate over time. The adoption speed of technology is going to increase exponentially, and it's going to be so fast. And, by the time 2030 comes around, you're going to be blown away by how much, AI has been adopted, right? And it's going to be in pretty much everything. Everything is going to have some type of AI in it. And I'm bringing that up because, this is basically why we're seeing such a large inflow into technology. This is where everyone wants to be. And I do think that, over time, technology is where you want to be. But maybe you want to be in energy as well, right? And then, and that's kind of like what a lot of this suggests. And energy tends to be a good hedge towards technology. If you take a look, the valuation of US tech is at the top of its range. So this is US tech, okay? And then these are some other demographics here. But tech, there's a reason it's trading at these really high ranges. Now, will it trade that long, at that high for so long? Forever, probably not, right? There's probably going to be a correction. But the thing that a lot of people misunderstand is that PE ratios and PE multiples and things like that, they've gone higher over time, right? As the world has developed and changed, people are willing to pay, higher multiples for different companies, right? 100 years ago, PE multiples were a lot different than what they are now. And, that's a reason why you have stocks like Nvidia, trading at such high PE multiples, and even after their recent earnings, their PE multiple actually went down because their earnings was so good. So from a valuation standpoint, Nvidia is actually cheaper now, strictly from a valuation standpoint, than it was just a few months ago. All right. So, we're seeing really interesting stuff. And I just kind of want to remind people that, yeah, things are a little frothy in the tech sector, but the environment in the world that we're living in right now is changing very rapidly. And, 50 years from now, 100 years from now, a 30 PE multiple for, some of the top tech companies in the world, that could be the new standard, right? So just some food for thought to show you guys. Now, one sector that really has been surprising me a lot is food, right? And basically food related stocks. When you look at Hershey stock over the long run and you take a look at its, how it held up, through the bear market and heading into 2023, this was a stock that was really surprising me, right? And one that I hadn't really paid too much attention to. And so I've been paying attention to a lot more of, food related stocks, and kind of junk food stocks, maybe you would even call them. And this is just showing a chart that basically all of them are bleeding massively, right? So you have Conagra, you have Campbell Soup, General Mills, Kraft Heinz, Kellogg, Hershey's, all of them experiencing significant drops, really big moves to the downside. And so maybe these are some companies, right, where, if you're one of those people saying, hey, technology is too overbought, I can't buy into these valuations, maybe this is a sector where you want to do some research and see if there's a company that fits some of your valuation and fits some of your preferences, and maybe you can find something in there worth investing that you think. Okay, now this right here is going to be the 2023 and 2024 bottom up EPS. And basically what we're looking at, we have the 2024 EPS estimate on top, then we have the 2023 EPS estimate on the bottom here. And the estimates have basically been stable since March of 2023. The reason that that's pretty significant is because that's when we had the banking crisis, right? That's when we saw SVB fall, as well as a few other banks. And what we're actually seeing is a slight uptick, right? We're seeing a 12% EPS growth expected in 2024. Oftentimes, the market is forward looking, right? And so it's looking ahead and it's looking at next year, looking at that 12% EPS growth expectations. basically in the market, and that could be a reason why the market has been rallying, right? This right here is going to be your average stock correlation with the S&P 500. This is just good stuff right here, and what we're seeing is it's very much a stock pickers market right now, okay? Or you could say the opposite, really, because the average correlation is very, very low right now. And so basically what this means is that, whatever the S&P 500 is doing, there's a very low correlation to individual stocks and what those are doing. Like, is every stock following the S&P 500 right now? And that's really not the case. So, you could say it's a stock pickers environment, and where, if you're really good at picking stocks, then those could be outperforming the S&P 500, or it could be, a really difficult time to be a stock picker. All right, if you're focusing on individual names, and the S&P has been rallying, and meanwhile your stock is bleeding. So a couple different ways you can look at that. Now, so here we are looking at crude oil. This is basically the juice of today's video, right? Energy is a big part of inflation. Of course, core inflation metrics take out things like food and energy. But at the end of the day, if energy prices are going up and oil prices are going up, that's going to spread out into everything, right? Because you use energy to transport goods, and so if the cost of transporting your goods are higher, then oftentimes you'll see the price of goods rise to kind of match. And what we're seeing here on a shorter term basis is crude oil breaking out, right? We have this very old zone, right? Old supply becomes new demand, right? So resistance, we topped out here, all right? It becomes new demand, support, and yet again, support. So what we're seeing is that we're breaking out from, and this is a weekly time frame here. So we've had this pretty significant downtrend really since the peaks here in 2022, and then we've started to come down, and we're recently breaking out very cleanly here as well. This was an old area of supply and liquidity, right? So sell liquidity here, all right, and then sell liquidity here, and it tried to sell back down again, but what we see is that imbalance was flipped from a supply imbalance to a demand imbalance, and now that's actually pushing prices higher. Now there's lots of global things going on, with energy that's also helping fuel some of this price. But just from a price action analysis and technical analysis, this is very clean, right? At the end of the day, you look at the major ranges, right? And, old supply becomes new demand, and we're pushing higher, breaking through a major downtrend. And when you take a look from even a further out, you can really see how clear the breakout in energy has been, right? So, this is 08 right here. This is the peak in 08. And then it's been on the steep decline, right? And then ever since 2021, energy broke out. It had the significant pullback, came back to a major area of liquidity, and now it's pushing higher again. And it's very possible we could be seeing something like this, over the long run. This is just something to consider, that, it could come up to 100. And, it's even possible, guys, that we come back and test some of these previous highs that we've had, back above 100. And it's entirely possible energy could head back up to the 140s. Now, I'm not predicting that it's definitely going to go that high. There's going to be some serious issues if energy goes back up to 100 or goes back above 100. Okay. And these are going to cause issues in things like, not only, the economy, but also in tech stocks probably too. Right. So, if we talked about how, the world is changing right now, and, advancing, and how AI is really going to, the adoption of AI is going to be spreading like a wildfire. So, if you're long a lot of those companies, it may be a good idea to add some energy into your portfolio as a hedge, right? And just in case things go bad, and we see energy prices spike and cause some really bad economic things going on, this can be a good way to potentially hedge your portfolio, right? If we take a look at the relationship here, so we in white, what we have is the XLE divided by SPY. So that's a ratio chart, basically showing you, if this chart goes up, all right, if the white chart is going up, it means that energy is outperforming the S&P 500 as a whole. And then here we have the SPX here in blue. This is going to be basically just your standard S&P 500. And lots of times these have inverse relationships, right? Not always, but if you take a look here, when the stock market's dropping, what are we seeing? Well, we're seeing energy outperforming the stock market here. And we're also getting this very similar thing here currently at the moment, where the energy to SPY ratio has actually just recently broken out of a downtrend. And when you look at the S&P 500, if it's going to have that inverse relationship again, this kind of suggests that maybe the S&P 500 is due for a pullback, because energy is outperforming the S&P, and this chart here is breaking out. And we see how oftentimes when this is going up, it results in the stock market going down. So just something to pay attention to, something that I'm looking at. We have the XLE divided by SPY versus the 10-year treasuries. And so again, this is a really good way of, monitoring and understanding, energy and how it performs relative to the market. And what do we see here? Well, we see that there's a very close, correlation, right? We have the 10-year yield here in yellow, right? And, as this is going down, we see, our ratio chart here of energy, going down. And then as this starts to bottom out, we see this, our energy chart here also starts to bottom out. And, the peaks in the valleys are very similar, right? They're not going to be 100% correlated. But you see, we top out here, and we start to get a pullback. We top out here, start to get a pullback, then we start to bottom, start making higher lows, and then we get that significant rally, right? Pullback, and then we rally up higher, make new highs. And what we're seeing yet again, right, is another breakout, right? We're seeing a breakout here of a trend, okay? Breaking out from this trend, all right, and breaking out from this trend, basically both of them breaking out at pretty much the same exact time, right? And so you're seeing treasury yields breaking out, you're seeing energy breaking out. And the reason again being for this is largely due to how energy impacts inflation in the market. Okay, and right now yields are being driven basically off of the inflation reports, off of CPI, and off of people trying to come up with expectations for what the Fed is going to do, based on things like inflation and energy prices. So these two, they follow each other pretty well. This is some interesting data, I think, as well. Now, this is our XLE SPY ratio chart. Again, just some simple concept, guys, that we're going to keep repeating, right? You have your old levels become this new levels, basically, right? And so we can see that we're essentially looking potentially for another 5-wave move to the upside. Okay, we've started our original 1, 2, 3, 4, 5 up. Okay, and after we hit this area of liquidity here, we were expecting a pullback, right? And sure enough, that's what we got. Energy started to pull back, and now it appears we could be potentially starting our next 5-wave move up, and we'd be looking for a retest of this area here. And we'd actually be looking for a breakout retest and actually another push up higher, up to this next area of liquidity, right? This is going to be the next major area of liquidity. I may update the chart and include this zone here. Okay, this is going to be a pretty important zone. But ultimately, if we get another 5-wave structure, this would be kind of like our wave 3 area here. Okay, and then wave 5 would take us up to the very top one. So again, a ratio chart. So as this is going up, this means energy is outperforming the S&P 500. And we take a look at another one, XLE, XLK. All right, XLK is your tech sector. Very, very clean, guys, very clean setups, right? Old liquidity comes new liquidity. We bounced off of the zone. We're pushing higher. And, for a very long time, I've kind of predicted that this was going to turn into a cup and handle once we hit our peak here, right around our previous levels. And we started to get this pullback. I said I really wouldn't be surprised if we come back down, test this area here, and then start to rally back to the upside. And that's what we're trying to do right now. So if this continues to rally to the upside and break out past this and make new highs, this is going to be something basically telling you that energy is outperforming tech. And we can see here that energy has really been outperforming tech since maybe late July. is basically, kind of when we've seen that correlation, maybe early September, or maybe, I'm sorry, early August. But that's basically what we're seeing, right? Is we're seeing energy outperforming the broad market, and we're seeing also energy outperforming tech. And, we know how powerful tech is and how powerful, basically how much tech has been really carrying the market this year. So I wanted to point that out. Both of those are things that I included in the newsletter. I put the XLE, both of these charts, these ratio charts. I did a whole piece on energy in the newsletter. Remember, it's completely free. You're going to get really good, valuable information in there. Okay. If you guys are fans of free, valuable content, you'll really enjoy it. And I'm also sprinkling in some free trade ideas as well. Again, we went over the Tesla trade setup here. Tesla rallied, very significantly. We basically had two chart patterns, that we were looking at, and both of those played out very nicely, resulting in some very nice profits. And don't forget, if you ever want to book a one-on-one personal coaching session, you can do that now through Ko-Fi. Okay, so head on over to Ko-Fi, book a coaching session. You can request a YouTube video, or if you guys really appreciate the content and you ever just want to give out a tip, you can always buy me a coffee through Ko-Fi. And that's going to be it for today's video. Right now, if you want to know about the bond market and TLT and what's happening there, go ahead and watch this video right here.